So, you want to trade stocks in India? Let's pull back the curtain and demystify the whole thing. We're going to follow the entire journey of a single stock trade, from the moment you hit buy to the moment the shares are yours. Let's get right into it.
You know, it feels so instant, doesn't it? Just a little tap on your screen and boom, you're an owner. But that one click actually triggers this incredibly complex, high-speed chain of events. And we're going to walk through that entire journey together, step by step.
But before we dive in, we have to talk about the guardian of the entire system. That's SEBI, the Securities and Exchange Board of India. Think of them as the referee. Their whole job is to protect you, the investor, and to make sure the market is fair for everyone. Pretty much every rule and process we're about to discuss exists thanks to the safety net they've built. Okay, so before you can even think about buying a stock, you need to get your foot in the door. And that means setting up a couple of essential accounts. You're going to hear these two terms a lot: DMAT and trading accounts. The easiest way to think about it is this. Your trading account is like your shopping cart. It's where you browse, pick your stocks, and place your buy and sell orders. Your DMAT account? That's the secure digital locker where the shares you've actually bought are stored. You absolutely need both, and they work hand in hand.
Now here's a really common misconception I want to clear up. When you buy a stock on your app, your money isn't going to the company itself. Nope. You're actually participating in the secondary market, which is just investors like you trading existing shares with each other. The only time a company gets your money directly is in the primary market, like during an IPO, when they're selling brand new shares to raise money.
All right, you've got your accounts, you've put some money in. Now for the fun part, placing that order. Let's look at what happens in those critical seconds right after you hit the button. Right away, you have a big decision to make. Market order or limit order? It's really a question of speed versus price control. A market order is all about speed. It says, just buy it for me right now at the best price available. A limit order is about control. You say, I will only buy this stock if it hits this specific price or lower. The trade-off? With a limit order, your trade might not happen at all if the stock never hits your price. And this is where the Indian market is just incredibly efficient. As of 2023, India is fully on what's called a T+1 settlement cycle. What does that mean? It means if you buy a stock on Monday, that's T-Day for trade day, those shares will be officially sitting in your DMAT account by Tuesday. That's T+1. This makes it one of the fastest, most advanced settlement systems for any major economy on the planet. So the trade went through. The shares are coming your way. But what did it really cost you? A lot of new investors get a surprise when they realize the brokerage fee is just the tip of the iceberg. You've seen the ads everywhere, right? Zero brokerage. And yeah, your broker might not be charging you their own fee, but, and this is a big but, that does not mean the trade is free. There's a whole bunch of mandatory government and exchange fees that are impossible to avoid. Let's just quickly run through the list for a standard delivery trade. You've got the Securities Transaction Tax, or STT, which you pay when you buy and when you sell. Then there's stamp duty, which you only pay when you buy. After that, you've got these tiny little fees that go to the stock exchange and to SEBI. And finally, there's this thing called DP charges, which only kicks in when you sell. You can see how all these tiny percentages start to add up. So what the heck are DP charges? Well, they're basically a flat fee you pay anytime shares are moved out of your DMAT account. This means you only ever pay them when you sell shares that you've held for more than a day. No DP charges when you're buying, ever. And here is the single most important thing to know, the thing that catches everyone off guard. DP charges are a fixed fee per company you sell in a day, not per share. So whether you sell 1 share of a company or 1,000 shares, the DP charge is the same. And because it's a depository fee, not an exchange fee, it won't show up on your main trade receipt. You have to dig into your account ledger to find it. Okay, let's fast forward. You made a great trade, you sold your shares, and you made a profit. Awesome. But the journey's not quite over. Now we got to talk about taxes. Any profit you make when you sell a stock is called a capital gain. It's a pretty simple concept, and the way it's taxed in India all comes down to one single question. How long did you hold the stock for? The rules are actually pretty straightforward. If you sell a stock in 12 months or less, that's a short-term capital gain, and it's taxed at a flat 15%. Simple. But if you hold on for more than 12 months, it becomes a long-term capital gain. And this is where it gets interesting. The tax rate drops to 10%, and even better, the first 1 lakh rupees of your total long-term gains every single year are completely tax-free. We've gone through the mechanics, the costs,
the taxes. But now we need to talk about your role in all of this. Because while the system has a lot of protections built in, you, the investor, have rights and responsibilities you need to know about.
And if you remember only one thing from this whole section, let it be this, straight from SEBI's own rulebook. Make absolutely sure that anyone you deal with, your broker, everyone, is registered with SEBI. That is your #1 most powerful shield.
So here are the key things you should always be doing. Make sure your KYC information is totally accurate. Actually read those rights and obligations documents they send you. A really great habit is to go to the stock exchange website and verify that your trades are recorded there. And of course, check your account statements all the time to make sure everything adds up.
And just as important, here's what you should never do. Never, ever, ever share your password. If someone promises you guaranteed returns in the stock market, you should run the other way. That's a massive red flag. And this is critical. Only transfer money to your broker's official company account, never to some employee's personal bank account.
But what if something does go wrong? Well, the good news is there's a very clear process to get help. You always start with your broker. If they don't solve it, you can escalate your complaint directly to the stock exchange. There's a proper system, a safety net, in place to help you out.
And here's one last really important protection for you. Your broker can't just sit on your uninvested money forever. SEBI has a rule that says at least once every quarter, they have to send any idle cash sitting in your trading account right back to your registered bank account.
And there you have it. From opening an account to that first click, through all the hidden costs and taxes, and finally understanding your rights as an investor, you now know the entire secret life of a stock trade. So the only real question left is, what are you going to do with that knowledge?